Round one. Fight.
Hello and welcome to World of Oil Derivatives. I'm not Greg Newman, the CEO of Onyx Capital Group. I'm actually Ehsan Nasser, the head of research here at Onyx Capital Group. In today's episode, I'm joined by Vincent and Martha from the research team. A quick reminder before we get started, this podcast is also available on YouTube if you would prefer to watch it. Right, I guess the main theme of the week has been the OPEC Plus meeting over the weekend. It was one of the lengthy meetings in comparison to the previous months. It ran for like 7 hours and there was a lot of tensions before like going into the meeting because some of the news agencies were banned from like being around Bloomberg, Reuters, and also Wall Street Journal, if I'm not mistaken. But Vincent, maybe you can give us an intro of like what that was about and what happened and how market reacted.
Yes, so I think the market reaction, it was more about the headlines and what the journalists wrote rather than the actual futures market itself, with all the drama that comes with the OPEC meetings. What we're missing now is Donald Trump's reaction and his tweets, as were the case back in 2017, 18, and 19. But this time around, there was a lot of hype, or as Saudi Energy Minister Prince Abdulaziz would say, a lot of suspense in the market. But the outcome, the aftermath of the meeting left the market more confused as to what the OPEC, or more specifically what the Saudi strategy was, because the consensus was that they backed themselves into a corner. It was a damned if you do, damned if you don't moment.
Yep.
People thought, okay, a production cut, targeting short sellers, speculative buyers to bring more stability into the market, but none of that was achieved. Instead, what happened was Saudi seemed to have gone solo, to put it lightly, cutting another 1 million barrel per day for July, which has interesting port output to down from 10 million barrels per day down to 9 million barrels per day, which, excluding the COVID times, it is actually a 10-year low. Yeah. And at the same time, UAE was a bigger winner. They won, in line with higher production capacity, they won a high quota for 2024. And at the same time, Russia seems to have got away scot-free, as they say, free riding on the Saudi output cuts. So a lot of drama in terms of the actual market reaction, in terms of futures prices. Initial bullish reaction, but it seems to me that the gains were given away by the end of Monday. Interestingly, because of the Saudi output cuts, they would have ceded a lot of market share and hence market revenue, because there was not as much of a bullish reaction to prices. But we can talk about what we'll talk about later is that Saudi actually raised their official selling prices, or OSPs, to Asia, and also there was a bullish reaction in the Dubai crude swaps market.
Yeah. Before we get to that, right, we're going to talk about the OSPs and we're going to talk about the Dubai market. But what I saw on the post and on the post on LinkedIn and Twitter and people reacting to this to the news of Saudi cuts, it was quite interesting because it wasn't a 0 and 1 situation that this is going to be bullish or bearish. People were a bit confused of how they're going to take in this information and really do something with it in the market. And it seems like the oil traders were not too bothered about this. I saw in one of the North Sea roundups that they actually translated the strength of yesterday, translated it from the strength in the North Sea market, because trade houses were buying cargoes, and that resulted in stronger flat price, rather than looking at, there was a big headline coming out the day before. They kind of dumped down the reduced the effect that you would get from these sort of meetings, and completely ignored that and looked at, right, people are buying cargoes. That's why there is strength in the North Sea market, and the North Sea market strength is translating into Brent futures and flat price. But obviously, as market opened, it opened quite strongly, and how much was it up? Like, I think it was up like around $2 or 2.6% or something.
Around 3% or
Yeah.
$2 to $3. But crucially, it didn't hit the $80 mark.
Yeah, and if you compare this to the previous cuts, the initial bullish reaction that we saw back towards the end of April, beginning of May. If you compare that, what sort of thing is it that we can take away from this? They did a cut and price movements. How were these, these headlines and the market reaction comparable?
During April, the cut was took the market by surprise. The market wasn't expecting it. So there was definitely an initial bullish reaction. I think we could say that OPEC used their bullet in April upon market open on Monday morning. Asian trading, Brent jumped up from $79 to $85, 5%, 6% increase, and it was an instant jump. It was as if OPEC wanted to defend a price floor of $80. There was immediate bullish reaction, and actually prices were held around that level, trading around the level for the next 2 to 3 weeks, until the macroeconomic and recession fears returned. But that was quite bullish, and OPEC didn't say anything before to suggest that there would be output cuts. But of course, prices came off again down to low 70s, mid 70s. And there were concerns about weaker demand as well. So sort of forced OPEC to make another move again. But it seemed like this time around, because of the lower flat price environment, there seemed to be some sort of division, internal strife within the OPEC members. Specifically,
that's why it took 7 hours to actually come out.
7 hours, and they were also
banning
banning journalists from the top Western media outlets as well, which is unprecedented. Even the previous drama in the past few decades, none of that had happened. So this was a big first, and why was that happening? No one can say for sure, but the only certainty was that there was a lot of tension somehow, and Saudi wanted to they wanted to take on the output cuts, but it seems like the strategy isn't working for now. It
seems like their control over the market is diminishing. They overplayed their hands a few times, and they keep on threatening market participants that you shouldn't be doing this or you shouldn't be doing that. But obviously free market is free market, and like market moves with buyers and sellers. I know that information that's really kind of gives the traders insight to what to do comes from like all these headlines and all that. But again, it's a matter of like, how much do they believe in these information? How much do they believe in these headlines to actually put their money and bet on prices? So our overall outlook obviously is now the market is kind of range bound, and like it seems like it's quite resilient in terms of not prone to be affected by these headlines. Seems to be quite balanced. But again, we think that there's going to be a reset in prices if you are waiting to see like a directional move in Brent. We've got to like go a little bit lower, and then like bring in like new participants like the SPR buybacks and stuff like that. That is going to like really bring in new speculative flows for the market to move. But there was a lot about the second half demand recovery. I think that you wanted to touch on that, Martha. Maybe it was another topic. Was it?
I think just right now, I'd just like to go back to what Vincent said earlier about like the UAE and how this is like a good thing for them and how Saudi are treating them well, that they have this addition in their like production that they're like quote unquote allowed. But in reality, this is like still quite far below their like maximum capacity. I think in 2020 it was 4.1 million barrels per day, and they've been agreed to be allowed 3.2. So that is still really significantly below their like maximum capacity they could be doing. And I think for it to be framed as a a positive thing is, good for the Saudis, as they're being seen as nice and, one tiny way. But I think that this will further like divide the countries which are already on, shaky ground. And I think this will be a really interesting thing to kind of see how that develops, the relationship between the two of them.
Yeah. I mean, it seems like UAE got what it wanted, right? But one thing that was quite interesting, that was missing from like the previous meetings. This time they published the production targets from Jan 24 all the way down to Dec 24 for the whole year, right? And this kind of gives the market participants more insight on what OPEC is going to be doing, and they can like place their bets accordingly. Something that was missing from the market from the previous meetings. Like every time there was an OPEC meeting, there was a lot of speculation whether they're going to cut, they're going to increase production, they're going to keep it steady. But this time, there seems to be a lot more stability in terms of like production targets for the next year. But obviously, in the language of the Prince Abdulaziz and the way that he put it, was like the 1 million barrel cut is just going to be for July, and they're going to be reviewing further cuts for the next months, right? And it seems like maybe this is not the end of it, but at the same time, Saudi Arabia needs the revenue from these oil production to be able to fund their mega projects, right? This is something else that like has been coming out on the news and the headlines. There's a lot going on. Maybe Vincent, like if you want to give us a run through of like what it is that they're trying to do, and like now the production in July is going to be 9 million barrels. If you're going to go down to like 8.5, 8 and lower, is there going to be a risk for the whole country, for the whole like revenue of the country, and how they're going to be going around funding their big projects and bringing in new investors? There's a lot of football players going to Saudi Arabia these days as well, like Karim Benzema. Like I think yesterday he signed for Etihad, I think, if I'm not mistaken. But like there is a lot, like they're trying to like make the whole kingdom more attractive for future investments, and they need the revenue, right? Can they afford to go lower than 9 million barrels? That's the question.
Well, it depends on the extent to which they want to get their mega projects done. Of course, very, 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 very ambitious, and Aramco they want to be heralding the energy transition, especially because of their production and output, their capacity, to be one of the last oil majors, NOCs standing. And yeah, of course, the break even is very, 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 very low, just a couple dollars per barrel. But yeah, a lot of mega projects all started with Ronaldo's exit interview with Piers Morgan and him leading the way. We could say he was the pioneer. Now we have Karim Benzema, who we wonder who's next. Or it could be a haven for retired players. Maybe if David Beckham was still playing now, he wouldn't have gone to America. But
China had a phase like this, right? Like bringing in like players from like European leagues, and to boost up their people's interest in football.
They had, yes, for sure. I remember 10 years ago was they had a couple of Chelsea players. Nicolas Nelka, Didier Drogba going to Shanghai.
Oscar as well, from like the Brazilian player, I think. Yeah.
Not too sure, but enough about football for now.
Yeah,
Let's
yeah.
go back to the
But-
oil and yes.
But what I was gonna say is like
Yes.
you talked about Aramco, and now we are very close to like break even, and market expectation for the OSBs, where like people expected to see a cut. I think Reuters ran a survey. It's just like seven buyers that they. I'm sharing my screen for the people who are watching. So the survey was done with like 7 buyers of the Saudi related crude grades, and the consensus was that they are going to cut the price of OSB for the flagship Arab Light. This was a week before the actual meeting, but what we saw was an increase in the OSBs to Asia, to Europe, and to the US. So it seems like they're trying to compensate, the pressure on the flat price using the OSBs in a way. Some other analysts, I think I saw like in the news that they mentioned that this is a good indication of the demand is still out there. But to me, it feels like, right, if we're not going to win the flat price war, we can like increase our official selling prices and maybe like compensate a little bit on there. But then again, the problem here is you've got Russian crude grades that are trading at $20 discount to the benchmarks, and Saudi Aramco raising its OSBs. Are they going to lose more market share because it's more expensive, especially in the Asian market?
Logically, they would be losing market share. I'm not sure about the specific numbers, but it did seem like, I think for China, imported more. They usually import more. Their top, the country they get oil from the most was Saudi Arabia, but I think it was Russia last year. If that could get confirmed, that'd be great. But basically, yes, Saudi
that did flip. Like,
yeah,
as in, like,
Russia is eating into
Yep.
the market share of East Asian, into Saudi Arabia's market share in East Asia. But with the OSP, that was an interesting one, because if Saudi cut their OSPs, that would have been a very bearish signal, signaling that there would be less demand. But then they actually raised the OSPs against market expectations. One thing I saw was because Saudi, when they're selling to other countries like China, for example, they sell their crude on long-term contracts. So it means they could set the OSPs to whatever level. Countries like China would have to be the price takers.
Yep.
Whatever volumes, whatever OSPs the buyer would have to accept. So perhaps now they say that the OSP, the rise is down to because Saudi will be cutting their output, so there would be less available volumes. So they need to raise the OSP to make up for the lower market share as well as low revenue, because clearly there wasn't a bullish response in the wider flat price Brent futures markets.
Yeah, it's so I guess like this kind of reversal in market expectation and what actually happened in the OSBs was kind of well translated in the Dubai market, right? So over the last 2 days we've seen Dubai spreads had a really decent rally, from the lows of like 35 cents all the way up to like 60 cents in the front. July Augie is strong, Augie SEP is strong, and off the back of this, Brent Dubai has come under a lot of pressure. Like it broke the $1 barrier earlier today. If you go on a daily chart for Brent Dubai, the last time this actually happened was again towards the beginning of May, end of April, when Saudis came out with their surprise cut. Your July Brent Dubai came under a lot of pressure, and it broke the $1 barrier. But then, it steadily rallied, but now is again coming under pressure. It's quite interesting because like we had a similar thing happening, beginning of last month, right? And when all the short positions like were in their P&L was looking pretty good. There was a small reversal, right? Are we kind of expecting the same thing, profit taking flows, and like how can we look for such opportunities? When a market is skewed towards the short side, which it is in this case, and all the short sellers are in the money, what sort of thing is it that you guys look at as a sign of like a reversal, like shorts taking profit, etc.? What is it? What indicators are the main ones?
Well, monitoring the changes in open interest, as well as seeing if there's more buy side interest, buy side flows coming in. That would be the most obvious one. We don't know when, but it seems like shorts are on the money, well on the money, and if there's any headline that would be bearish for Dubai crude, then that would be it. And since most of the market and Brent Dubai spreads are positioned on the short side, it means that also with open interest beyond at levels that's well above
higher
what we've
than
seen,
5-year average,
higher than the 5-year average.
Yeah,
it means that whoever wants to go short is already short. So it means when there is a price reversal, there may not be enough people on the other side, more sellers to absorb this buy side flow. So it was interesting. It seems like for the sellers, they've been in the money for the entirety of 2023 so far, and it did look like the market was going to rip upwards towards the end of April. But looking at our dashboard, especially where the shorts were entering, it seems like the prices were just very close to about a dollar range. They were very close to surpassing where the shorts were entered. So the shorts were about to get out of the money, but then boom, on that, it was a Friday and prices surged downwards once again, seemingly seeing like shorts, they were trying to defend their positions. And over the past month, the Brent Dubai spread has steadily rallied upwards, reset at a high range. So with this new with the new news of the OPEC cuts, which was bullish for Dubai crude, it was another reason for shorts to again, come in and defend their positions and make some more profit. So it seemed like the trade following the OPEC cut, it wasn't necessarily the Brent futures, but it was the bullish traders would have been focused on the Dubai crude market, and there would have been more opportunities there to express their bullish view in Dubai crude. So what was interesting was that following the OPEC cuts on Sunday and the market reaction on Monday, the Brent Dubai forward curve actually shifted lower as a whole. Before, you could see in the front, June, July, August, Brent Dubai, it was slowly trending upwards. But towards the back, Q4, it was still very stable, range-bound trading. But then after yesterday's news, even Q4 came down as well, in addition to June, July, August, September.
Yes, the whole curve is resetting now.
Yes.
To lower levels. We'll go talk about something else. Enough about OPEC. I think we covered pretty much everything there. I know that in the propane market, there was interesting stuff going on. Yesterday it was like a really strong market in NGLs, and you did a video about Panama Canal last week, right? Do you want to remind us what that was about, and what could be the link between Panama Canal and what is going on there with the strength in the NGLs market, especially in the US?
Well, previously it was more linked to Panama Canal and weakness in the US propane market. Now it seems to have turned into strength. such as the volatility in the commodities markets, because when you look at it physically, of course, propane is being traded, cargoes are being moved around the world, and from the Gulf Coast to Asia, of course, naturally the quickest route is through the Panama Canal towards East Asia, like Japan, Korea, China. And before, you saw that there were some headlines linking the lower water levels around the Panama Canal with climate change. Of course, it was in a similar event to the lower Rhine water levels last year. With the Panama Canal, they imposed some draft restrictions, which would have forced ships to carry less of a load, because if it's too heavy, then there would be logistical issues. There would be a higher risk of them not being able to pass the canal, given that the water levels are so low. And with that, this would exert upward pressure on transportation costs. Costs of freight, carrying ships, and that also raises supply costs, and hence also generates upward pressure on inflation. And also high energy prices as well. So within the propane market recently has been quite weak, because the stock builds in the US are quite healthy, above market expectations.
So all the products are staying in the US.
Less exports, lower export levels as well, especially since the arbitrage to Europe is technically closed right now, as Europe stock levels are quite healthy. So the only really viable arbitrage is towards East Asia. But in the past few weeks, we've seen freight prices rising, the BLPG is rising, but at the same time, the LST FEI spread, which is the arbitrage between US propane and East Asia propane, that's becoming wider. So with high freight prices, and there's still a need for cargoes to land in East Asia, the ARB has to widen for as a price signal to incentivize traders to continue sending cargoes towards the Far East. And the same trend actually happened over December and January, where there was a lot of delays in the Panama Canal owing to fog issues in the Gulf Coast, which also meant that the LST FEI ARB had to be really wide, and so was the higher freight prices. So with that, we could see, it's because of weather, it's because of the low water levels, it's because of the climate, or if that has an impact on commodity prices. And what I was saying in the video is that the environmentalists, I mentioned Just Up Oil, they have a point, but at the same time, for traders with these events affecting commodity prices, there's also always an opportunity to make money. I think you mentioned before, during the Suez Canal, when there was a during that crisis, Evergreen,
Ship,
and traders were also asking, how do I make money? How do I make a profit from this? And within the commodity market, where so much of the trading is based on geographical arbs around the world, reflecting the different prices of different locations, and freight prices must be reflected in this. It's a perfect chance for those aware of the market to see, identify opportunities to make a profit from this.
That's I mean, that is very, very important for traders, looking at the freight routes and looking for the disruptions in the logistics, and the Evergreen crisis in the Suez Canal. That was a really, really interesting one. So I remember back then, one specific product that had a really decent flow, naphtha, decent flow over to Asia. Those east-west levels found a lot of strength, and people started trading it. But it was resolved very, very quickly. But one event might not actually mean anything that is happening on the supply demand picture yet, because you've got like 30 days, 40 days voyages, and it takes time for the product to actually move. But people will start like betting on these way ahead of like actual delivery. So I think the whole crisis was probably for like 4 or 5 days, but already the effect was reflected into the financial market. And like, we just officially started like entering the hurricane season in the Gulf Coast, and also in Japan, and or generally like Asia, and also your Gulf of Mexico, and a lot of logistics get affected by these hurricane seasons. We've done like a thorough study before of like how the market reacts to the news of an hurricane coming around, what sort of refining capacity there is in the areas that are affected, how much product is offline, how much product is bound to stay in a specific region. And Martha is actually going to start, putting together a daily hurricane watch that we're going to like send out to our clients, and it's going to be very, very important. And weather plays a very, very important role, especially in like specific markets like the NGLs market. But there is small logistical issues can translate into tens of dollars of move in an arbitrage.
Just off what you were saying about the Panama Canal levels, and players betting on like which way it's going to go. I think that if you believe the weatherman, there's going to be maybe a 90% chance of El Nino happening in Central America this year, which is going to be like super drying, and the correlation to like the level of the the Panama Canal, where they measure whether they can let the ships through, how heavy they can be, and these El Nino events in the past, because I think they can happen like with fairly high frequency. And I mean, we just had one last year, if you remember, everyone's lawn went brown, but like it's going to, it may be another really, really significant event that's going to be happening in the summer, possibly.
Yeah, and that's all the time that we have today for this episode of World of Oil Derivatives. Thanks for listening, and be sure to tune in for next time for more updates and insights.